Hi everyone, welcome back to my channel. Been quite a while since I've put out a few videos, but we're getting close to the launch of Liquid Loan, so I thought it'd be a good time to drop a little bit of info that I've been getting asked to do quite often, and that is some yield strategies and how you might like to play the game when Liquid Loans finally launches. Not sure when that exact date will be. We'll leave that up to the core team to get those dates out to us, but they're telling us it's not far away. So now's the time to jump on testnet and try out some of these strategies and see what maybe you might be interested in doing when it does actually launch. So what I've looked at doing is I'll probably break this into definitely more than one video, maybe two or three, depending on how I go. This video is just going to be a quick look at the strategies in terms of the high level overview and just give you basic three good strategies you might like to use. And then for the people that are a little bit more, or sorry, a little bit less tech savvy, maybe you can go watch the second or third videos where we actually step through how to do these. They're not difficult, but some people just like that little bit of comfort factor where they can see how someone's actually gone through the process. So we might do more of a little bit of a how-to type video just as a supplemental to this one. So for now though, let's just have a look at three general strategies, and you can mix and match these to suit your requirements. But the way I'm looking at it is we've got three risk tiers. We've got the low risk, which is minimal risk to your capital, which is your pulse that you're going to deposit into the system, and low exposure to volatility in price of the assets you're holding in terms of US dollars. So if the price of Pulse is to go up and down dramatically based in US dollars, does that leave you with a shortfall that you can't cover debt positions and things like that? So we're trying to come up with a low risk strategy that means you're not exposed to that. Then we've got the medium risk strategies, which is there's a risk of loss to your capital, but can be mitigated because we're holding particular assets that we can, if we need to, liquidate those assets to pay down any debts on the vaults. So I put that in the sort of the medium risk category where we've got some exposure to USD price risk, but there's a way we can mitigate it within certain parameters. So we'll have a look at that. And then we've got the higher risk strategies. Usually for a higher risk, you'd expect a higher return. But as long as you understand what game you're playing, then you can actually have a look at the higher risk strategies. But in general, higher risk strategies are probably where you're going to be putting the capital, the collateral, at more risk of a liquidation than you would in any of the other scenarios. So let's quickly have a look at these three risk tiers and some different plays within those risk tiers. Very wordy slide, this one, so I apologize for that. Normally I'm quite a graphical person, so I'll do good pretty pictures and things like that. Just wanted to keep this pretty low tech. You can come back and read the slide at your own leisure, but let's just step through basically what the strategy is, and we can piece that all together with a how-to video later on. So strategy one, it's a stable yield play. So what I mean by that is we're not venturing too far from stable coins, but we're trying to capture any yield that we can get by using the protocol and the actual stable coin that the protocol produces. So let's have a look at how that might work. So the goal is just yield generation. We're not trying to maximize the appreciation of our assets that we're holding. So it's purely a yield type scenario. It does have some other benefits though. So the risk tier is low because, like I said, we can mitigate any type of liquidation type events by the way we deploy this strategy. So how does it work? In a nutshell, we're going to deposit our pulse into the vault. And we're going to do it at a very healthy collateral ratio. Now, what's healthy for me and what's healthy for you is entirely different, but just understand the nature of these assets. They can move quite dramatically in USD price terms, even more so than like a more mature asset like Bitcoin or Ethereum. So this same strategy on Ethereum, you would apply differently on Pulse Chain because we think that the price of Pulse is probably going to be a little bit more volatile. So we basically deposit our Pulse into the vault. We're going to mint USDL based on that collateral ratio that we deem we're comfortable with. Very simple strategy. We're then going to deposit that USDL into the stability pool. Now, we'll step through how that mitigates your risk, but really what we're after in this instance is a yield opportunity. So essentially we'll be long Pulse. So we're still holding Pulse, although we've locked it up in a vault. And we're also long Pulse because we're in the stability pool. So we've taken our USDL and we've put that into the stability pool. Now, what that means is if there is a liquidation, not of your vault, but of someone else's vault, then a bit of your USDL will be extracted out of the stability pool to pay down their debt. And in return, you will get given Pulse. And it'll be at about a 9% discount to the current market price where that's liquidated. So if you were to put in $1,000 worth of USDL into the stability pool and there was a liquidation, you might see $50 or $100 of that disappear out of your USDL balance in the stability pool, but you'd get it replaced with the equivalent value in Pulse. Now, if you wanted to continue being in the stability pool with your $1,000, you would have to claim that Pulse, sell it back to market to redeem it for the USDL value, and then top up the stability pool. So we're looking for the yield in, so hopefully we should get a bit of discounted Pulse if we're in the stability pool. But the other big thing is we're after the loan token that you get given whilst you're in the stability pool. And that's a really aggressive distribution mechanism for the first year, and then it halves every subsequent year. So the returns you'll get in loan token the first year will far outweigh the returns you get in the second year. So that the yield you're getting from that position is the loan token. Now, what do you do with the loan token? Well, you can choose. You could go sell it for USDL and capture that yield in USD terms, or you could put that loan to work further in the protocol. And we'll talk about that in a second. So what have we just done? So we've put some Pulse in a vault, extracted some USDL value, and then not sold that USDL for anything else, but just put that in the stability pool. So how do we protect our vault from liquidations in the event that the USD value of Pulse goes down? So if the value of Pulse drops and our vault gets into a stage where it could be deemed a risky vault, so the collateral ratio is now getting quite high, then collateral ratio is getting low. It works in the inverse. So if our collateral ratio gets to about 110%, then that's not good. So if it's getting to that point where it's risky, how do we mitigate that risk and get our Pulse back before it's liquidated? Just by virtue of having your USDL sitting in the stability pool, it's fairly liquid. You can withdraw it from the stability pool. So if you were to have an issue where you've seen the price drop of Pulse, but you're still holding a USD value from the USD that you minted, you can sell that on market. Sorry, you don't need to sell it on market. You can withdraw that from the stability pool, go and pay down the debt on your vault and get your collateral ratio looking nice and healthy again, and possibly even close out the vault. If you needed to, you could exit that position entirely. Now remember, on this protocol, there is a couple of minimums. One of those is you must have a minimum loan of 2,000 USD equivalent. Okay, so if you want to go below that, you have to close out the vault. You can't have it at $1,000 debt. The system just won't let you do it. You'll have to close out the vault. All right, so let's have a quick look at some of the notes regarding this particular strategy. So as you incur loan fees, so when you deposit your Pulse into a vault and you extract some USDL in the form of a loan, the debt, you pay a fee, and that fee is a variable fee, but starts at about 0.5% and can go up to, I think it maxes out at about 5%, but that would be very rare. So that fee means that if you were to borrow $2,000 in terms of a debt, there would be an additional amount for the fee. Now, what that means is if you just took your USDL out, so you minted it, set it in your wallet, and then you went, oh, I've got to pay back the loan, you would have a shortfall because you wouldn't have enough USDL to meet that fee. Easily fixed, you just buy a bit of USDL on market, and it should be a relatively small amount. That way, if you needed to close out the vault, you would have the USDL that you withdrew, plus you would have a little bit of a surplus from USDL that you've brought on market, and you could close out the vault. So it doesn't matter whether you're using this strategy or not, you are going to pay that fee. So you just need to be mindful of that with this protocol. All right, should you wish, you could also pay back the debt over time using yield from the loan token. So remember we said you're going to be getting some yield generation in the form of the loan token, but it's actually a pretty useful token. You can go put that into the staking pool on the protocol, and when you do that, you get given more yield. You get given yield in terms of pulse when there's a liquidation event, a redemption event, or you get given USDL when people are generating a loan. So that fee that you pay when you generate a loan, that goes to the people that are staking the loan token. So if you are taking the loan token that you're earning in the stability pool, staking it on the system, you're getting given more USDL, which you can then in turn use to pay down the debt on your vault. That puts you in a better collateral type position. So it's a nice little feedback loop that we can use, and you can see why this one's a pretty low strategy approach, because we're not giving up any assets. We're not leaving ourselves exposed to volatility in the USD price of any assets either. Now, slight variation on this one, where we could seek a higher form of yield than what the stability pool offers us. What that means is we've got to venture outside the protocol. So we've got to look at other protocols in the ecosystem, and PulseX or Fux protocol is one that we could look at. And so how would that look? So let's just say we took our USDL that we minted and we took it across to the Fux protocol, and there was a stability pool there where there was maybe the Coast guys have paired, so we can see the Coast token paired with some DAI and some USDL. That'll probably get paired up as well as soon as that's out in the wild. So you could actually go and provide liquidity in one of those pools, and you're not subject to price fluctuations because you're dealing in a pool of stable assets. Look, unless something terrible goes wrong and one of those assets depegs from its value, that's a different story. But by and large, the stables pools are generally pretty safe, and you might get an above average return, APY, for doing that, as opposed to staying within the protocol and being in a stability pool. That's a judgment call you can make. But what the important takeaway from all of this is, don't sell that USDL into another speculative asset. Keep it in a stable coin type scenario, whether you're holding it in USDL in the stability pool or you're pooling it with other stables, so that you're not subject to price fluctuations of that asset. Okay, does that one make sense? I'm going to have a quick drink of water and then we're going to move on to a medium risk strategy. Bear with me 1 second. You'll have to bear with my croaky voice. I'm coming off the back of a meetup in Sydney with a bunch of Hexagon guys, so my voice still hasn't fully recovered from that situation. All right, let's have a look at strategy number 2. And this one's a speculative growth play. So a little bit more risk involved. As soon as you hear the term speculative, you've got to assume the word risk, okay? So what's the goal of this one? Speculative growth and yield generation. So we're adding that extra little twist to try and maybe get a little bit more out of the value of our assets. So we put this into the medium risk tier. What does that mean? There's a chance that we've definitely got more exposure to USD values in the assets we're holding. And that consequently means that we've, as an offshoot of that, we've got a little bit of exposure. Maybe we could get liquidated, okay? Depending on how degenerate you go on what assets you use in this speculative growth play. So let's have a quick look how this one works. Same thing as the first one. you put some pulse into the vault, and you once again extract some value at a healthy collateral ratio that suits your risk. And I don't want to go into collateral ratios in this video. If you want to understand that, I've got a whole bunch of other liquid loans videos where we discuss that in more depth, so go back and check those out. So we've deposited our pulse. We've now got the ability to mint some USDL. So let's extract some USDL out of the system. Now, this is where we get that little twist. We're going to swap that USDL for an asset of your choice. Now, this asset's moving away from another of the stable coin type offerings. So we're going into the speculative side of things. So HEX, the loan token itself, PulseX, and there's no shortage to how you play this. These are just 3 examples. And the reason why I like HEX and loan is there's some unique characteristics of those particular assets, and we'll discuss that. Okay, so with those assets that we purchase, now it could be a straight out, I'm going to go buy token XYZ because I think it's going to go 100x. And essentially what you're doing is you're holding onto your Pulse collateral. You're not letting that go, so you're still long Pulse. You haven't relieved yourself of that position. You've essentially taken a little bit of leverage against it though. So you've extracted some value out against that Pulse. And then you're going to buy another speculative asset on the hope that that asset goes up, and ideally you'd be able to pay back the loan on your vault. You've freed up your Pulse, and you've also got yourself a nice little bit of extra cream from either holding some excess tokens or ending up with more cash in your wallet after. Cash is probably the wrong word, but more value in your wallet after you've gone through that process. So that would be that'd be pretty degenerate. You're basically betting on a speculative asset going up. I like pairing it with something like HEX or loan because you're still long your Pulse. You haven't gotten rid of your Pulse bag, but then you've brought an other asset that you probably know pretty well and are pretty comfortable with, and that other asset produces yield. So HEX produces yield, we know that. And I've just mentioned that loan can produce yield as well. So rather than buy USDL, put it in the stability pool and earn loan, you could just go straight out, buy it and put it in the staking pool on the actual protocol and get the fees from that, help pay down your loan. With HEX, you could stake it, and the interest you earn from that HEX, you could pay down the loan. So I hope you can see that where I'm sort of going with this is you're not getting rid of your primary Pulse position. You're taking a bit of leverage, getting something else that you like, and hopefully earning interest or yield on that asset and paying back your debt on your vault. Now, the problem with that is because you've extracted a US dollar value amount in the form of a loan, let's call it $2,000 worth, then you've gone and purchased $2,000 worth of asset, whatever, let's call it HEX. You purchased $2,000 worth of HEX. Now, if the price of HEX drops by 50%, so now you've only got $1,000 worth of USD value and you need to pay back your vault, you're $1,000 short. So that's what I mean by you've got some exposure there on the USD side. So just as long as you understand that and you know what you're doing, then you can use this to your advantage, but just understand that there is that USD price risk. Okay, so I think we've pretty much covered the growth opportunity is obviously holding the 2 assets and hopefully getting that yield out of it as well. We've talked about how you could get caught out if the price moves against you, because that is also how you unwind your position. Like if you needed to get out of that position very quickly and you didn't want your vault to get liquidated, you would have to sell down whatever asset it is that you've purchased. You just need to be mindful how you pair this up. Now, if you've purchased HEX and you've locked it up for 6 months and the price moves, do you think you can get that out quickly? No. So just think what the strategy is you're doing and adjust the collateral ratio on the vault accordingly for what strategy you are using, what asset you're purchasing. If it's, I'm going to go buy Doge 2.0 and I think I'm only going to be in it for a week, well, you'd treat it differently. And it's obviously a lot different, more speculative asset. But if Doge 2.0 goes to actual zero, so the value falls down, then you've got an issue there. You've got a debt position that you need to cover. So just understand that. That's how you unwind it, is you'd have to sell those assets back. Let's have a look at some of our notes. So the performance of the asset you buy will determine the outcome of this strategy. Well, that's pretty straightforward. If you go buy Doge 2.0 and it gets rugged, that's a different scenario to if you go buy Hex and you're getting some yield off it, and so totally different strategy. So you'd have to adjust your vault accordingly. You can pay back any debt on the vault with yield earned on the secondary asset and essentially be both long assets. So that's why I like if you team it up with a yield generating asset, that's when I think this strategy is really cool. This strategy works well in a bull trending market. So if we look across and we say, look, we think we're going to be in a bull market for the next 2 years, this strategy works really well because you're able to be long on two different assets, get the yield from it. It's as long as that chart's going up, happy days. Now, being in a bull market trend doesn't mean the price always goes up. We get 30-40% pullbacks on the regular. So don't think that you're going to be immune from that. Just understand that this strategy does work well over that longer bull trend. So what have I got here? A variation could be that you buy more loan token and stake for USDL yield to pay back the debt. So we've sort of covered that as well. So you either like a Hex one where you get more Hex and your goal maybe just to get more Hex, or you might want to use that interest from the Hex to pay back the debt. Same with the loan token. There's a few options there. And look, there's so many other assets out there that I've lost count of what's going on in the ecosystem now. So you may have some other UBUT asset that you think this will work perfectly with. As you are purchasing a secondary asset with the debt, you are actually putting the debt to work. Just do it safely. In this regard, if you need to reduce exposure, you could sell the asset to pay back the debt. So choose the assets wisely that you're going to pair up with this, because you are putting your pulse, you're taking the value from your pulse, extracting a little bit of it and putting it to work. But if that moves against you, it would have been better off just holding your pulse. All right, I'm going to have another quick drink and then we're going to go on to the high risk strategy. All right, strategy 3, speculative high growth play. So you're less interested in the yield aspect. You're going all out. You're trying to maximize the value of your pulse and really take an aggressive approach to trying to magnify how much you actually have. So you've probably heard of this strategy before. So the goal is aggressive speculative growth and actually improve how much pulse you're holding. And you may know this as the haunted strategy. Now there's a number of different takes where this is slightly altered and there's a lot of different moving parts to this. I'm not going to go into the haunted strategy in detail. There's many videos that you can find. I think I may have one as well. But there's many videos on how this strategy works. So if this is something you're planning on doing, go back and find those videos. There's lots of good information around. It's been a while. We looked at this sort of stuff almost 2 years ago. So probably would pay to make a bit of a refresher on it and actually get on testnet and play around with it and see how this works. But effectively, let's have a look what we're doing. So once again, this is in the high tier risk. So we're going to deposit some pulse into the vault with a very healthy collateral ratio. And I mean very healthy collateral ratio. So we're going to mint the USDL. And so we're talking collateral ratios at 900%, 1000%. So remember, the system will let you go down to as low as 110%, but as soon as you do that, you will get liquidated. So on average, most vaults would probably sit around sort of the 150 to 160 mark in a collateral ratio on Ethereum. And we understand Pulse is going to be a little bit more volatile. So we want to naturally up that up to 250, 300, just for the safe strategies. And then when you're using something more aggressive, you want to be in the 900 to 1,000 sort of mark and beyond, hopefully, with these strategies. The safer you make it, the better off you are, because this is really effectively what it results to is getting a lot of leverage on your pulse. But you can do that in a controlled way. So we're not going like 100x leverage, where we're being a little bit tamer and we're doing it, but there's risks. So let's have a look at that. So effectively, we mint a bunch of USDL, keeping our collateral ratios high, and we swap that back for Pulse. All right, so this is important. So remember what we've just covered. So if you've deposited Pulse into this stability pool and you've minted a bunch of USDL, turned it into Pulse, you are very exposed to the US price movements of Pulse now, because you've gotten rid of the USDL. So if you need to repay that debt and you're holding Pulse and the Pulse is falling, you're taking a double whammy. So you're very long Pulse in this scenario. So we're going to get that Pulse, get a USDL, swap it for Pulse, and then we're going to pop that back into the vault. Now that's good because that actually improves our collateral ratio. But we still have that risk where we no longer have that asset. So if we wanted to pay down that vault, we've got to find another means. Very hard to extract it when the value of Pulse is falling and the collateral ratios of your vault are getting questionable. And the only way you can pay it back is by removing your collateral, which puts your vault at more risk. You've got to be very careful in the way you do that. Now, in saying that, there's some cool tools getting around where you should be able to do flash loans and things like that to pay back your vaults, but that's way too advanced for what we're talking about here. And I don't even know if those tools are available yet. So let's see what the teams are building. But that's something that does exist on Ethereum, and I'd like to think that it finds its way onto Pulse Chain. Okay. I've waffled a little bit, so let's quickly recover. Deposited Pulse, withdrew USDL, turned it into Pulse, put that back in the vault. And now what we're doing is after we see a certain percentage of growth in USD price terms. So let's just say we've got a bunch of Pulse and it's worth $10,000 in USD value. We've extracted $1,000 of value, turned it into Pulse, put that back in the vault. So now we've got $11,000 worth of value sitting in our vault. And the price of Pulse goes up. Generally, you try to do this on 10%, but that means a lot more management. But let's just, for easy numbers, goes up 100%. So we've now got $22,000 worth of Pulse sitting in our vault, but we've only extracted $1,000. Well, we've got a bit of headroom there because our collateral ratio is now huge. Maybe we can pull a little bit more value out, and we might pull out another $1,000 worth of USDL, turn that into Pulse, put that back in the vault. Basically, you're just building up more and more value into your vault as the price of Pulse goes up. But you've got to be super, super careful doing this, because if the price reverses, you are heavily exposed to that price risk. But that's essentially the way this strategy works. Like I said, there's a whole bunch of videos on the Haunted strategy, and you can play with the different values and tinker around with it. But even if you just go to testnet and actually go through the mechanism and see, okay, well, if this is what I do, what does that mean for my collateral ratio when I do actually put the Pulse back on the vault? So that's worth having a look at. So the growth opportunity here is we're going to be continuing to hold Pulse, but we're building in a bit of leverage because every time it goes up, we're extracting some value from it to build up our Pulse bag. Now, the exit strategy is you want to make sure that by the time it comes around to closing down the vault, you've built up enough economic energy in there so that the value of Pulse has gone up so much, and because you're holding multiples of it now because you've been acquiring more, the value's blown up, you can sell a portion of that down to pay down the debt on your vault, and then your collateral's free and clear. So you've used it wisely, you've grown your bag, but then you've paid down the debt, so then your Pulse is no longer at risk of liquidation when we inevitably go into what is going to be a bear market in however many years' time. Now, so like I said, you'll be fully exposed to the USD price of Pulse, and not holding a secondary asset with any value that you can pay down the debt on the vault with, unless you've got other bags somewhere else that you can do that. But understand this strategy is looking at it in isolation. You won't have any assets to pay back the vault. So that there is a risk that you could get liquidated. Once again, so looking over at our notes, this strategy works well in a bull trending market and is effectively getting you a levered position in Pulse without any carry costs on the leverage. So if you go to a normal exchange and you want to get some margin and get some leverage and do effectively margin trading, that comes at a cost. So you have to pay a certain percentage every day for that leverage that you've achieved from the exchange. Now, the beauty of liquid loans is we don't have any interest on our loans, so that's effectively a carry-free cost. Obviously, there's every time you take out a bit more of a loan, you have to pay the loan fee, but there's not an ongoing interest expense in this system. So that is pretty unique and pretty clever. This is a very active strategy. You can't just set it in there and walk away and forget it. You're going to need to monitor your collateral ratios. You're going to be wanting to monitor the price movements of Pulse. So if you do want to extract the value and leverage up a little bit more, you've got to do that in a safe way, and you're going to be watching the market to do that. Okay, so it is a very active strategy. You can adjust the risk by altering how often and how much you leverage up. So we said in the original Haunted strategy, every 10% move up, you would take a bit of value out and put that into the vault. Now, we know we can move 10% in a day. So how do you assess what is a true 10% move? Do you look at a moving average and say, when the moving average goes up 10%, okay, that's when I know I'm going to take my extra and leverage up a little bit? Or I don't want to do 10%, I want to wait 20%, 30%, because I want a bit more headroom in when I'm extracting value to make sure that I'm not putting myself at risk. So you can tweak those percentages how you like, and you can also tweak how much you extract each time you do that. Big takeaway here, this should only ever be performed using a smaller part of your core portfolio. So whatever you do not just go, look, I'm going to go crazy, I'm going to put all my Pulse bags into this and I'm batting for the fences, because inevitably things will go sideways and you may lose your whole bag. But if you're going to do this, take a small portion of it, set it aside to run this strategy. That'll protect you in two ways. If there is some crazy volatility or a black swan event, you're protected. So you're not going to lose, not going to wipe out your own bag, but it'll also give you the chance to just get a feel for how this is actually working. Is the strategy working for you before you've gone too deep into it and you have to back out in a way that's not suitable for you? So ease into it, and also you can split and have several different scenarios running here. One I'm going to be more aggressive with, one I'm going to do at 20%, one I'm going to wait till 100%. So you can actually carve off different portions of your portfolio and have different risks within this strategy. All right, so let's just close this off because this video is getting a little bit long now. I didn't want it to be too long. The general takeaway is we've basically had all the financial Lego laid out in front of us. On Pulse Chain, we've got the liquid loans about to be released. You've got the FUX system where you can go into the pools and do that, get extra yield that way. We've got HEX where we can grab hold of that asset, get the appreciation and yield. And then PulseX is all pools and farms and all sorts of things that are going to come about on there. So you've got all these different Legos that you can plug in together. So make use of what are effectively interest-free loans. Let's put them to good use, do it safely, but have a bit of fun with it. Like there's so many different strategies, not just with these core coins that I'm talking about. There's a raft of different things we can do. So get your thinking caps on, start to think about how you can do this and see all the opportunities that are just laying at our feet. Very early days, there's no hurry to jump into all of this. Take your time, learn how it works, but there's just so much opportunity on the table. Okay, I'm going to close this video off now. Like I said, I might go back and I'll do some how-to videos. So if you're interested in one of these particular strategies, I'll step through how it how it's set up. Most of them are pretty basic, and you've probably used all the different tools like Hex and everything before. So we're not talking anything new, but some people like the comfort of where we just step through and do that. So I'll produce one or two videos that quickly run through these. Hope that was useful. Looking forward to seeing the launch of Liquid Loans, as I'm sure many people are. It's going to be fun times, guys. Let's get on with it.